Hey, this is Mindy Strong. This video is going to help you better understand the section of management companies. If you are studying for the Series 65 and want an overview, here you go. We're going to discuss the general characteristics of management companies, and that is essentially looking at funds that are created to serve an investment purpose. First of all, we have a fund sponsor, also known as the underwriter. They must register with the SEC, and they have to include a prospectus which details the objective, the board of directors, any fees, and the track record of the sponsor. There are three types we're going to look at. First of all, we have open-end funds, mutual funds. I had a really hard time looking at and remembering the difference between open and closed. Open-end funds are mutual funds. You're ready to have you are open to having mutual fun. That's how I finally got myself to remember it. You are open to having mutual fun. So mutual funds do not trade in the secondary market. They're continuously issued. There's a net asset value, also known as an NAV, and there is a sales charge, and together that is the public offering price. Now we're going to look at selling groups. A selling group is a group that sells for the sponsor. And remember, the sponsor is also the underwriter. The selling group is going to earn a selling commission. And they have offers of open and closed shares. Okay, so open and closed shares. And then we have closed-end funds. So this fund is issued one time, it's closed, and then it trades in the market. These shares trade in the secondary market. So open to having mutual fund, these are issued continuously and they are redeemed with the issuer. Closed end, they're issued one time and then they trade in the market. Okay? Investment advisor manages the fund, and they are elected essentially for 2 years, and then the shareholders vote on the investment advisor, and the investment advisor receives fees for advising. Another term you need to know is custodian bank. The custodian bank safeguards the assets of the fund. They act as the transfer agent to cancel old shares and issue new shares, and they receive fees for doing that. So the investment advisor advises and receives fees. The custodian bank keeps everything safe and helps with any transfers, canceling and issuing new shares, and they receive fees for that. There is a rule called the diversified fund rule. And the best way to remember this is 75, 5, 10. 75% or more should be invested in securities. This is to ensure that you have a diversified portfolio or a diversified fund. Maximum of 5% should be invested in one issuer, and a max of 10% invested in voting securities in one issuer. 75, 5, 10. This would be something that I would memorize if I were you. Okay, now we're going to look at the different types of funds. So first of all, we have growth funds. We've talked about growth funds in our other videos. These are our equity securities. You want capital gains. You want growth. If you are looking for growth, you're going to get an equity security. And then there is income. Income is wanting to prioritize fixed income securities such as preferred stocks and bonds. A person who wants income, something reliable coming into them, is going to look at fixed income securities and preferred stocks and bonds. Obviously, these are less risky than our friend growth funds. And other types of income funds would be U.S. government securities, municipal bond funds, and again, I mentioned preferred stock. We have corporate bonds and money market securities. Now, if you're looking at combining growth and income, then, you would want to combine equities and fixed income securities. Makes sense. Now, balanced fund is balancing those fixed incomes and securities so that we have capital gains, which we get from our growth, but we also have the income, which we get from our fixed income securities. An index matches a fund, and if you have an index, there are going to be lower management fees. A specialized fund is when you get a fund that is specialized in a certain sector, a particular industry, or a geographic area. For instance, if you want to get a fund that specializes in, say, utility companies, then that fund would be comprised of different utility companies. That would be a certain sector. Now, special situation funds are the riskiest. These have large potential gains. Generally, it's a bankruptcy takeover or some other crazy takeover, a special situation. But these people know they're taking on more risk, but they have the potential of more reward. Okay, so again, we're going back to our open-end shares. You are open to mutual fund. Open-end shares are continuously being issued by the sponsor. There's only one type that will be in there in these accounts, and that is common stock. These are redeemable at any time by the sponsor, but they are non-negotiable. They are not traded. If you don't want this mutual fund anymore, you redeem it with the sponsor. That's the only way to get rid of it. For these open-end mutual funds, the net asset value is computed daily, and that should say net asset value, not NVA, NAV. It's increased or decreased by the asset appreciation. The asset appreciation or depreciation if it's decreased. Again, they do not trade in the secondary market. The value of these is divided by the number of shares. When you hear the term no load, that means no fees. So that would be one that is sold at the NAV. The NAV and the POP at this point would be exactly the same if there are no fees. And for money market mutual funds, that's a lot of M's, there is a $1 constant NAV. The max sales charge on these is 8.5%. That's the total of all fees that FINRA allows. And when you buy or sell, it's redeem. When you redeem, buy or sell, meaning when you redeem or get these, buy these, you're going to get the closing day price. The closing day price, which may be different than the current price. Sales charge percentage. Again, let's look at that. There's a max sales charge percentage of 8.5% of the public offering price, FINRA states this as the max, so it can't be adjusted. Forward pricing means exactly what I said. You don't know the cost until the end of the day. So you choose, yes, I want to buy or redeem, and you know exactly what that cost was when markets close at the end of the day. A redemption fee can be charged, but remember the total fees cannot exceed 8.5%. And there is often a contingent deferred sales charge. So what the issuers say is, listen, we want you to keep these funds. So if you redeem these in the first year, you're going to pay a 6% contingent deferred sales charge. If you keep it for 2 years, we're going to drop that to 5%. If you keep it for 3 years, we're going to drop that to 4%, and until it goes away. So this is intended to get people to hold on to these funds. fees. So there, I went over some of these, but let's go over all of them. Redemption fee, again, all of the fees combined, including sales charge and redemption fees, cannot exceed 8.5%. FINRA says so. Contingent deferred sales charge goes down as a person holds on to that fund over time. Breakpoints, basically, they say, listen, we're going to give you a reduced sales charge if you spend more money with us, if you invest more money with us. However, if you're part of an investment club, nope, can't take advantage of putting a bunch of people together to get these breakpoints. That is not okay. Letter of intent. So let's say that you don't have the money to make that break point. Let's say the break point's at $10,000 and you don't have the whole $10,000 right now. You have $8,000, but you intend to add another $2,000. So you can write a letter of intent and you say, listen, I'm going to buy more in the future. And it's sort of like you owe me this break point when I do get to that $10,000. So that's a letter of intent. Rights of accumulation. You can get points that count toward that break point. And often, if you stay within a company and you want to switch from one fund to another, they will waive the fees because they want you to stay with the company. Okay, cool. Okay, then there are 12B1 fees. These are fees that are assessed to gain more customers. These must have 7.25% or lower fees, so that's the rule for that. 7.25 is the highest. And then we look at share classes. So we're going to look at Class A shares, Class B shares, and Class C shares. If you purchase Class A shares, you are playing the long game. And notice I put a bunch of A's because we're in Class A. Class A, you're playing the long game. So there's no greater than an 8.5% sales charge, but the fees are higher up front. So they're loaded. There's a sales charge that's loaded up front. Generally, there are lower 12B1 fees, which are the continuous fees that you get every year. These Class A shares are intended for long-term investors, for long-term investments, because over time there's lower annual fees. So if you're playing the long game, you're going to get Class A shares. Class B shares have that contingent deferred sales charge that goes to zero. So remember, this is like, listen, if you leave us within 1 year, then you're going to have a 5% fee. If you leave us in 2, you'll have a 4%. So there's that decreasing contingent deferred sales charge. But they do have higher 12B1 fees, which are the annual fees. So this is for intermediate investments, right? Because after a few years, that contingent deferred sales charge goes away. And then we have Class C shares. See you later. So with these, there's no upfront sales charges. They have the highest annual 12B1 fees. And this is for short term. So see you later for Class C shares. So you're willing to pay those annual fees, and those annual 12B1 fees are going to be a little larger because you don't want to be locked in. You don't want to have to play the long game. So Class C shares. Okay, publicly traded funds. So these are not our mutual funds. These are our closed-end funds. They are issued one time. There are no new stocks that are issued. They are issued, they are closed, and then they trade in the market. So they are illiquid securities, like municipal bonds. They cannot be redeemed with the issuer. They can only be sold because they've been closed. They trade on the stock exchange and the secondary market. Management companies only sell these. They never buy them. And often you will find these in a managed portfolio. Publicly traded, so they're closed. Okay, closed end. So either they can be sold at a discount or they can be sold at a premium. Well, they're sold at a discount because they are giving a lesser rate of return when compared to the market, so they have to be sold for a little bit cheaper. Makes complete sense. If you want to sell something and the rest of the market is doing better, you have to drop the price to get yours to sell. And then closed end that sell at a premium, they sell at a premium when they are giving a better rate of return relative to the market, so you can charge more. Makes sense. Okay, here we go. So fund income and taxation. So first of all, there is a statement that shareholders receive semi-annually. It includes an income statement, a balance sheet, and the listings of holdings. Makes sense. They receive this once a year. There are fund expenses. Those are the operating expenses. There is a management fee. That is the largest expense of operating, obviously, is managing it. There is a shareholder servicing fee. That's customer support services in case anyone needs help. There are custodial fees. Those are the bank fees that the banks charge for keeping it safe and acting like the transfer agent. The printing fees, that's for printing the statements and the prospectus and the as I said, the semi-annual reports. There are the legal and audit fees. Funds are audited annually. Somebody's got to pay for that. And then there are the 12B1 and administrative fees, and those are to attract future shareholders. All of these are fees that must be paid. Okay. Expense ratio is where you take the total expenses divided by the total net assets. And that's where you get your expense ratio. Net income distribution. So 90% of the NII has to go to the shareholders in order for it to be considered regulated. As long as it's regulated, they don't have to pay taxes. And this is based on subchapter M. Now, there are still tax surcharges that are imposed if a company distributes more than 97% of its NII. And then there's a 98% of the capital gains to shareholders. So most companies want to hit that 98% of the capital gains so that they can escape as much of the tax burden as possible. Now, dividend distribution and capital gains distribution is expected and must be included on a person's tax return. And those are seen separately. So the dividend distribution is seen separately from the capital gains distribution. And that is the net income distribution broken down for you. So most companies want to get up to that 98%, but as long as they get to 90%, then they are considered regulated and do not pay taxes. Okay, cost basis for tax purposes. So what you do is you take the original purchase price and you add in all of the reinvested distributions. Those are the capital gains and the dividends, and that's going to give you the cost basis for tax purposes. Okay, this is just sort of in summary. Open-end mutual funds. You are open to having mutual fund. They are purchased and redeemed through an issuer. They are priced at the next NAV, which is the opening day, and they are priced once daily. Closed end, they're issued and they're closed, and then they are bought and sold on the secondary market. The price is dictated simply by supply and demand, and they are priced continuously throughout the day. So another little bit on cost basis. Basically, that's the price of the security plus the commissions. And then we have capital gains. The way you figure out the capital gains is you take the sales proceeds and you subtract the cost basis from that. And the way you obtain the sale proceeds is that's the amount of money from the sale minus the cost of selling it. These are formulas you need to know. These would make great flashcards. And that's it, y'all. That is the management company section. I hope this has been extremely helpful. Let me know if it has. Let me know if you have any questions. Thanks.